Welcome to the deep dive. Today we are getting into a financial statement that I think most people just tend to skip over.
They absolutely do. Their eyes go right to the bottom line.
Exactly. Everyone is obsessed with net income.
Yeah.
But if you really want to know if a company is going to survive, if it can actually pay its bills, you have to look at the cash.
And look, if we can get one single idea across to you today, let it be this. It's an analogy from our source material. Imagine you're on a desert island,
Okay.
and you can only get one financial statement to judge a company's health. Just one. You should always choose the statement of cash flows.
That is the ultimate financial mic drop. So philosophically, why does the statement of cash flows beat the income statement, the one that's supposed to show profitability?
Because the statement of cash flows gives you this complete unbiased picture of the company's lifeblood. It shows you the cash coming in and out from running the business, from its investments, and from how it funds itself.
Right.
So our mission today is to really explain why cash flow is about survival, about liquidity, and why it's this crucial reality check when net income, with all its accounting rules, might be telling you a very, very different story.
Okay, let's unpack that with the most famous example. The central paradox here is that a company can look amazingly profitable on paper and still just completely run out of cash.
Or the reverse. It can be reporting huge losses, but stay afloat because it's generating cash. And the best case study for this is the collapse and then survival of Circle K.
The convenience store chain. So they filed for Chapter 11 bankruptcy in 1990. I mean, they were on the brink.
They were. But here's the wild part. In 1991, while they're under court protection, the company reports a colossal net loss.
A huge loss.
A huge loss. And yet in that same period, they generated significant positive cash flow from operations.
That seems completely backwards. How do you fail the profitability test so badly but still bring in more cash than you spend day to day?
And that positive cash flow was their lifeline. It's what gave them the liquidity to reorganize, to survive. It literally bought them time, even though the business itself was, economically failing. It let them make payroll.
So net income is about whether you're creating value long-term, but cash flow is about whether you can pay the bills this week.
That's the perfect summary.
And if we zoom in on Circle K, the cash flow was, let's say, a little artificial, right? It was a product of the bankruptcy process.
It was largely artificial, yes. It was a result of legal protections, not a healthy business. Two really critical things happened. First, the moment they filed Chapter 11, they were allowed to just stop paying interest on their old debts.
Yeah.
That was nearly $100 million.
Wow. So that's $100 million in cash that just stays in the company.
It's pure, immediate cash relief. And second, and this is really insightful, their accounts payable shot up by about $80 million.
So their suppliers basically gave them a massive loan. Why would they do that for a bankrupt company?
Because bankruptcy law creates two classes of debt. You have the old stuff, the pre-petition debt, which ranks low. But any new debt you take on after filing gets super priority.
So the suppliers knew that any new invoices they sent would get paid before any of the old lenders saw a penny.
Exactly. They were incentivized to keep the trucks rolling. So Circle K got to keep its cash instead of paying old bills. It bought them time, but it didn't fix the real problem.
Which brings us to that core distinction.
The difference between economic performance and liquidity. Net income measures performance. It's accrual accounting. You book revenue when you earn it, not when you get the cash. Cash flow just measures liquidity, actual cash in, actual cash out.
And there are times when you absolutely have to ignore that net income number and go straight to the cash flows. Our analysis points to three key scenarios.
The first one is what we'll call the big loss scenario. This is where the earnings number is actually too pessimistic.
Right. This is when the income statement is hit by huge non-cash expenses.
Correct. Things like a massive asset write-down or big depreciation charges. These are just accounting entries. No actual cash is leaving the building. So the company reports a huge loss, but its ability to generate cash might be completely fine. That's the Circle K situation.
Okay, scenario 2 is the opposite, and it feels much more dangerous. The rapid growth scenario, where earnings look way too optimistic.
This is the classic growth trap. The company is reporting fantastic profits because sales are exploding. But to fuel that growth, they are pouring cash into working capital.
Building up inventory, letting customers buy on credit.
Exactly. Their accounts receivable is ballooning. And the most famous example of this is Home Depot back in the 1980s. They were profitable. But they were facing a true cash flow crisis.
Because they were growing too fast.
Way too fast. Every new store meant buying mountains of inventory before they could sell it and collect the cash. They were paying their suppliers quickly, but collecting from customers slowly. It created this huge cash deficit. They had to get emergency financing just to survive their own success.
So their long-term plan was working, but their short-term survival was at risk. A perfect case for the statement of cash flows.
And that brings us to the third one, the reality check scenario. This is when the earnings just feel a bit iffy.
Iffy as in management might be using some aggressive accounting assumptions.
Precisely.
Yeah.
Management has a lot of discretion. They can choose how fast to recognize revenue, for example. They can make the earnings look incredible. But cash flow from operations, that's much, much harder to fudge.
It's the raw truth.
It's the ultimate truth teller. It shows you if those sales are actually turning into cash in the bank. So let's actually deconstruct the statement itself. It really tells three different stories about cash.
And it always answers two questions. Where did the cash come from? And where did it go?
Right. And to calculate the biggest piece of this, cash flow from operations, most companies use what's called the indirect method.
Okay, and the indirect method is what connects that accrual-based net income number we started with to the cash reality.
You've got it. You start with net income. Then you add back any non-cash expenses, like depreciation, because that was subtracted for accounting, but not for cash.
Okay.
Then you adjust for changes in working capital.
So if accounts receivable goes up, it means you made sales but didn't get paid yet. So you have to subtract that increase from net income.
Exactly. You pull out that paper profit, and if accounts payable goes up, meaning you haven't paid your own bills, you add that back because you got to keep that cash for a little while. That whole process gives you the truth of category one, operating activities.
This is the core business engine. It's about sustainability. Cash from sales, cash out to suppliers, employees, taxes, and interest expense.
Then we get category two, investing activities. This is the long-term story, buying and selling long-term assets.
So the main outflow here is what they call capital expenditures, or CapEx, buying a new factory, new machinery. It shows if the company is investing in its future.
Yes. And if this section is heavily negative, it usually means they're spending aggressively to grow. That's a good sign.
And finally, category three, financing activities. This is all about the funding strategy. How do they get their money?
Right. Transactions with owners, so stockholders, and with lenders. Inflows are from issuing stock or borrowing money. Outflows are for paying dividends, paying back loans, and buying back their own stock.
Now, once you have these three buckets, there's a pattern you expect to see for a healthy, mature company.
There is. You call it the normal healthy pattern. It's pretty simple. Cash flow from operations should almost always be positive. The core business has to generate cash. If it's negative, the company is burning cash.
And cash flow from investing should almost always be negative. The company should be spending money to build for the future.
If you see positive cash from investing, that's often a red flag. It can mean they're selling off assets, having a sort of garage sale to raise cash, we'll come back to that, and financing, well, that can be positive or negative. A mature company is often negative, paying back debt or returning cash to shareholders.
Okay, so beyond just looking backward, the statement of cash flows is also a powerful forecasting tool.
Absolutely. If you're a manager, creating a pro forma, a projected cash flow statement, is not optional. It's how you test if a strategy is even viable.
It's a numerical reality check.
That's the perfect phrase. It forces all your plans to be internally consistent. You can't budget $100 million for a new plan, a negative investing activity, without showing where that $100 million is coming from.
Either from operations or from new financing.
Right. And the model will show you if your rapid growth is going to eat up all your cash and you'll need a line of credit in 6 months to make payroll. It finds those funding gaps before they happen.
It also acts as what our sources called a financial unifier.
I love that term. Because if you truly understand the statement of cash flows, you understand how everything fits together. It's the only statement that directly links the income statement to the balance sheet.
It translates the accrual accounting into cash reality and shows how that cash changes all your assets and liabilities.
You can build one of these from scratch. You've pretty much mastered financial reporting. You see the strategy behind the numbers.
Now, for all its power, it gets a little complicated when you look globally. There are some controversies in how things are classified.
Yes, specifically the difference between U.S. GAAP and the international standard, IFRS, on things like interest and dividends.
It's a conflict between making things comparable versus, what, theoretical purity.
Pretty much.
Yeah.
Under U.S. GAAP, the rule is simple and strict. If an item, like interest expense, is on the income statement, it has to be classified as an operating activity, period. It makes all U.S. companies easy to compare.
But the international standard, IFRS, is more flexible.
It is. IFRS lets companies choose. They can classify interest paid as an operating activity because it's an expense, or as a financing activity because it's the cost of getting a loan.
So you could have two identical companies, but company A calls interest paid operating, making their operating cash flow look lower, while company B calls it financing, making theirs look higher.
And that kills comparability. It's a real problem for analysts, which is why our research points to the UK standard as probably the best model.
How does that one work?
It just avoids the controversy altogether. Instead of forcing a choice, the UK standard creates separate, distinct sections for interest, dividends, and taxes.
So there's no ambiguity.
None. It's totally transparent, totally comparable, the much more elegant solution.
This has been a really thorough deep dive. So the key takeaway for anyone listening is that net income is fine for measuring long-term performance, but the statement of cash flows is the non-negotiable partner. It measures survival.
Cash is, without a doubt, king. And understanding this statement ensures you're looking at a company's real health, not just some optimistic paper profit that could be hiding a disaster.
And we'll leave you with one final thought on this, building on that normal healthy pattern we talked about. Positive operating cash flow, negative investing cash flow.
When you look at a company's statements, you have to watch for when that pattern is broken and stays broken. If you see a company that has chronically negative cash from operations, its core business is just burning cash, and it's generating consistent positive cash from investing. That is a massive, flashing red light.
What does that combination mean?
It means they are selling off their long-term assets, their buildings, their machinery, their future. They are selling parts of the company just to fund their daily losses and make payroll.
They're hosting a permanent, desperate garage sale.
Exactly. And that pattern is probably the single clearest sign that you need to investigate that company's viability, and you need to do it immediately.